So I invest for dividends and cash flow, and I invest across a variety of different industries, including the oil industry. And I haven't shared too many insights here on my YouTube channel yet about oil stocks, and so I wanted to dive in today and share 12 insights, 12 lessons that I have learned over the years investing in oil stocks. So get ready, it's going to be an exciting video. Welcome everyone to today's video. This one is a long time coming. I have had subscriber requests over the long term here asking me to review specific oil stocks, talk about oil stocks, and I have one subscriber in particular who has been very passionate lately about oil stocks, and so I thought it was time, and I want to thank you. I want to thank everyone out there for this suggestion. This is a great one, and I thought it was time. I thought it was time to finally go ahead and share some insights about my experience investing in oil companies. And of course, I own some oil stocks in my portfolio. I actually own 3 of them right now to be exact. And I'm going to make this a multi-part series here. I want to start today with 12 lessons, the top 12 lessons that I have learned specific to the oil industry, specific to oil stocks, from a dividend perspective, from a cash flow perspective, that I have learned over the years. So that's going to be my video today. And then in subsequent videos, I'm going to share some specific insights and some specific analysis of oil companies. And so let's jump right into it. Lesson number 1. Oil is a commodity. So here on PPCE, and I talk a lot about world-class brands. I talk about companies that I love. One of my favorite stocks of all time, for example, that I just discussed is PepsiCo. And Pepsi owns great brands like Pepsi Soda, Pepsi Cola. They own the Lay's brands of chips, Frito-Lay's. They own Tropicana orange juice, a whole bunch of other brands. And I like brands because brands create loyalty with consumers. Brands create great margins. There is so much benefit to having a great brand. And I'll link in the description below my PepsiCo video. But the fact of the matter is, with oil companies, the brand really doesn't matter. At the end of the day, all of these companies are selling the same thing, and that is oil. And at the end of the day, oil, whether you buy it from one company or another, it is the same oil. And the problem with that is when one is dealing in the world of commodities, one is basically tied to the price of that commodity. And as we all know, oil tends to go up, the price of oil tends to go up, and it tends to go down. It's a commodity. And so one of the key insights that any investor thinking about investing in the oil industry, whether it's for dividends like myself or for any other reason, is just realizing, hey, this is a commodity. And quite frankly, when I invest in a commodity industry, it's never going to be really a core position for me. I have some positions in oil companies. I own 3 to be exact. These are all kind of falling actually in more of the medium bucket in my portfolio, and there's probably more money in them actually than maybe I would like. But that being said, I took advantage of the recent downturn. I'll talk more about that later. But at the end of the day, the reason that I can't rationalize bringing oil stocks into core position is the fact that they are commodity companies. They don't really have a defensible pricing strategy that is based on brand. The pricing is based on the price of the commodity. So key lesson number 1. Lesson number 2 is it's really, really cyclical. The price of oil is cyclical. And as we just hinted at, a commodity, the price can go up, the price can go down. And these companies, they are dependent on the price of oil, yet they have no control over the price of oil. Let's go back to my example with Pepsi. Pepsi has a lot of control over the pricing of its products, and the pricing and the margins can be really favorable for the company because they have a brand, because they built a brand. In the case of oil, it doesn't matter what kind of brand one builds. One can have the best brand in the world, but because they are selling a cyclical commodity, they are tied to the cyclical nature of oil. And let's take an example here. As recent as July of 2014, the price of oil per barrel was $91. Fast forward to January 25th, 2016, it had tanked, it had cratered to $37.69. This is when OPEC decided just to go full throttle and not limit the amount of oil that OPEC was producing. They wanted to just flood the market and really use that opportunity to drive out some of the the North American-based oil fracking companies. And anyways, the price of oil just plummeted. I mean, this is literally in less than a year's time, it goes from $91 to $37. That is crazy. And so when one invests in an oil company for dividends, and one is relying on dividends to pay the bills, sometimes it can get scary when a commodity can fluctuate so much, because one starts wondering, hey, are these companies going to be able to continue to pay the dividends in that kind of situation? And actually, during this downturn, some of the companies actually had to cut dividends. We'll talk more about this later. Fast forward now to May 11th, 2018. The price has come back up a bit. It's at $70.70 right now. So we've seen kind of a just whiplash almost in the price of oil. It really just tanked, and now it's come back. It's not up to its prior peak, but it's certainly heading in that direction now. It's certainly recovered quite a bit, and at current levels of oil, I would say that most of the major companies out there, they're doing all right. At $37, they were not doing all right. A lot of these companies were facing hard times. They were facing challenge. We talked about the dividend cuts. I'll talk more about that later. At current prices, though, they're doing okay. And this is really important because as a dividend investor, I invest for cash flow and I need predictability. And when the product that's being sold is so incredibly cyclical, it can sometimes throw a wrench in my stream of income or predictability, especially if a dividend cut were to come. And so that's certainly a reason from a dividend perspective that I would never make an oil company a core position in my portfolio, but certainly I like them to have a place in the portfolio. So next one is the next insight number 3 that I've learned from investing in oil is it's all about buying low. And I've not always bought low. When I got started investing, I would buy oil companies just because I wanted the diversification. I like to have representation in my portfolio from all of the different industries, and I like to have a well-diversified portfolio. And so I wouldn't necessarily time it. I would just buy the oil companies, but that was before I learned all these insights about oil companies. That is before I really learned all of the lessons. And I went through a 2016 and I understood what could happen when OPEC floods the market with production and the price of oil can plummet overnight. And I learned these lessons. And what I learned is going forward, I will only buy oil stocks when they are just on absolute bargain basement prices, when the companies have tanked, everyone out there is terrified of them. Even I am somewhat terrified of buying because I know when I buy in at that current point, none of them are making money. They are losing money because the price of oil is at $37, but I have a hunch that it will one day recover as it has. And so the key here is whenever I want to buy going forward, I'm going to do exactly what I did in 2015. So right around 10/1/15 and in late September of 15, 9/28/15 was my best move yet in oil. That is when I really started realizing, hey, OPEC has flooded the market here with production. The price is down. I think it will eventually recover, but I'm going to take a calculated risk. I know these companies aren't making money right now. I'm going to buy and average into the ones that said they're not going to cut the dividend, and maybe they will cut the dividend because that risk is always there, but they told me they're not. I'm going to take it at face value, and I'm going to hope that this recovery doesn't take more than a few years. That's the kind of situation when I will buy oil stocks. Other than that, I will probably not buy them other than reinvesting dividends. Certainly right now in 2018, I'm not buying oil stocks because they have recovered too much. I have 3 oil stocks in my portfolio. Again, this is the first video in the series. I'm going to go into an example or two in the next few videos, so stay tuned for those. Those will be really fun. But here I just want to show high level of the 3 stocks I bought. Number 1 is up 49% since I bought it in 10/1/15. Number 2 is up 55% since 9/28/2015, and number 3 is up 69% since 9/28/15. And this is just capital appreciation. This doesn't include the dividends. And yield on cost actually is pretty good. Stock 1, I'm doing a 7.8% yield on cost. Stock 2, an amazing 8.12% yield on cost. And stock 3, 5.85% yield on cost. Not bad. So the purpose of sharing this is this doesn't happen every time. I've averaged into these oil stocks over the years, and certainly I've bought at times that maybe wouldn't have made as much sense. But this is an example of doing things right. And this is, since now that I've done it right, I understand this market really well. This is what I'm always going to do going forward. I'm going to wait for that buy low opportunity. And it can be very tiring. It can be it can be a long time. We don't know when this next buy low opportunity is going to come. It's going to require patience. And so this is something I always have to remind myself is be patient, Ian. Wait for that next buying opportunity. And quite frankly, taking a little bit of a side note here, this is why I'm so focused on consumer non-cyclical now. One, I love consumer non-cyclical, but two, all of my favorite consumer non-cyclical stocks, they're on sale right now in 2018. 2018, I see that is my strategic theme. When I went back to 2015, oil was a strategic theme because these were on sale, but they're not on sale right now. I'm already up 49%, 55%, 69%. They're not fully where they'll probably go, but they've recovered enough where 2018, it's not a strategic theme of mine. And that's just something as an investor, especially in oil, especially in a cyclical asset like oil, that I have learned. I have learned that it is important to wait and have the patience for that buying opportunity. So, next lesson I've learned, super majors. I've looked at a variety of oil companies over the years. In my early days of investing, I actually invested in an oil exploration company, kind of pure play exploration company, and I actually did pretty well in it. But what I've come to learn over the years, especially because it's cyclical, it's a commodity, is I want to own the super majors. What this means is these are the big companies. These are the brand name oil companies that one has heard of because they have gas stations that have their name on those gas stations. These are companies that are big, that are in the hundreds of billions in terms of market capitalization. The reason I like super majors is because of the fluctuations in this market, because honestly the technology is changing so quickly, because there is so much risk involved, and it is a hard business, it is a difficult business. I need a company like a super major, a big company that can basically weather the storm when the storm does hit, because the storm will come from time to time in this industry, and I trust that the super majors can make it through. Some of the smaller guys though, some of the newer guys, or even not so new guys, but smaller, I just get a little bit more concerned. Again, from a dividend perspective, I invest for dividends and cash flow. I've got my 8.12% yield on cost on this one. I invest for that cash flow. I need that cash flow to be there. I don't want it to get cut. I don't want it to evaporate. I want to invest in those super majors, those big brand names. And I don't want to be drawn into some smaller names that may have a really attractive yield. They may have a really attractive starting yield, dividend yield, but it just may not be sustainable the way a super major is. And so that's something that I learned as well over the years, and it's just a comfort level thing. I've really become comfortable investing in super majors, and one of the reasons, quite frankly, is they're actually in so many different types of businesses, and so they're in upstream, downstream, chemicals. So what is upstream? In terms of oil, upstream really refers to going out there, exploring, extracting, producing oil, getting oil out of the ground. Downstream, by contrast, is when a company refines the oil. So they take the crude oil, they refine it so that it can be sold as gasoline at the pump. It includes transportation of the oil. So now we've extracted this oil from the ground. How are we going to transport it where it needs to go? And it even includes marketing. How can we market this oil? And you see that a lot in terms of gas stations and branding on gas stations and such. And so there's the upstream, downstream, and even chemicals. Some of these big mega super major oil companies, they will actually use petroleum as a key element in creating chemicals that are used in industry as well. And so what I like about super majors is because they're in all of these different facets of the oil game, is they can weather the storm. When times get tough, I know, for example, some of the super majors doubled down on their refining business. They went all in on refining. And I know at a lot of these big companies, they almost have a dual CEO. They oftentimes have like a CEO or a president of their upstream business and a similar person who works on their downstream business. And they're both important. They both complement each other. And it creates a lot of security, in my opinion, for investors like myself. Well, I guess as much security as could exist in such a volatile sector as energy can be. So what else? In my opinion, lesson number 5 that I learned is it's all about current yield here. I do not expect to receive a ton of dividend growth on oil stocks, and in fact this is one of the key sectors where I really price in almost no dividend growth. Certainly stock number 3 of these 3 I'm listing with only my 5.8% yield on cost. It's a good yield on cost, but that's one where it will continue to go up. But 1 and 2 with my yield on cost now 7.8%, 8.12%. These are companies that are not aggressively raising their dividends over time. I don't expect them to. It's may or may not be in the cards in the future, but it's going to be slow. And so this brings me back to this point of buy low. These types of stocks, I like to buy low. I like to bring in a lot of current yield. But in terms of dividend growth, it's not going to be a growth engine for my portfolio. This is the part of my portfolio that brings some current yield to the table. It brings some yield should I want to tap into my stream of income tomorrow. And I don't want to wait for the growth of a company like PepsiCo, for example, where that one's all about the growth. Its current yield is nice, but it's all about the growth over time, whereas these companies, it's all about the current yield. It's going to be lower growth over time. Number 6, I like owning oil, and the oil industry, it provides diversification. So as I've talked about at length here on my YouTube channel, I love consumer non-cyclical. It's really important for me. In my portfolio, it falls really key in terms of my strategy. But I've also mentioned I like representation from all of the different industries. And I like owning oil just because the other day when all of my consumer non-cyclicals were tanking because those stocks are out of favor this year in 2018, it was funny, these oil stocks were actually up. I was actually doing well on the oil stocks, and who would have guessed that? It's crazy. When back in 2015, these were the most hated stocks I'd ever seen. People literally thought the sky was falling, that these companies were going to fold, that it was over for them. No one ever saw the price of oil recovering from that $37 level. They thought it was going to go lower. And so it's so funny just a few years later to see that turn of events. And that's how the stock market works. And that's why I like being diversified, because on any given day, you never know which of the sectors is going to be performing well. So number 7, in the oil industry, one has to be careful of dividend cuts. Dividend cuts are real. They happen. And during this recent downturn, a lot of the big names actually, or maybe not a lot, but several of the big names, ones that people wouldn't have expected to cut the dividend, they did. Thankfully, I did not experience a dividend cut on the 3 oil stocks that I own. However, on 2 of the 3, I was thinking, and I was planning actually for them to cut the dividend. I was hoping they wouldn't, but I was thinking, wow, if this price of oil does not recover soon, these companies are going to be forced to cut the dividend. And thankfully, the price recovered. They did not have to cut the dividend, but that is a real concern. And so if this is why I own 37 stocks in my portfolio. I can weather it if 1 or 2 has to cut the dividend. And I've told you guys in the past, actually, if a stock cuts its dividend, typically it's a deal breaker for me. In this industry, if one of these stocks cut the dividend, it may or may not be a deal breaker for me, actually, because oil is so cyclical. If there's a huge cyclical downturn, they cut the dividend. They may be bringing it back in the next few years. That is just how things go in this industry. That being said, I do still gravitate towards the companies that do not cut the dividend. And thankfully, the ones I own, they have not cut, or at least during the time period I have owned them, have not cut the dividend. One of them actually, I believe, did cut the dividend in years past. So The moral here is, one, the investor needs to be prepared for dividend cuts. The investor certainly wants to avoid them at all costs, but if a dividend cut does happen, it may not be an instant trigger to sell in the oil industry, but it may be as well. But I just know in my personal situation, in most other industries, it's an instant trigger to sell. In this industry, I would have to put a lot more thought into what's actually going on in the commodity pricing before I were to make a rash judgment to sell one company. But I love the ones that are strong, and that's the key here. Dividend cuts are real, so when one does invest in this industry, I always like to gravitate towards the ones that have financial strength, and those oftentimes fall in the super majors as well. So moving on, what else have I learned? I have learned that there's some risks here. Number 8, there's a demand side risk in the oil industry. I've read reports that the oil consumption, the peak of oil consumption, is going to happen as soon as in the decade starting 2030. So we're looking maybe 15 years out, 20 years out, oil consumption globally could peak. That's what some of these reports are saying. And really what's happening is 47% of, this is some interesting facts. In 2017, 47% of oil was used as motor gasoline. 20% was used as distillate fuel, which is basically heating oil and diesel fuel. And then 8% was used as jet fuel. That adds up actually to 75%. So the other 25% was used for all kinds of other stuff, such as chemicals, plastics. Oil is actually a key component in producing plastic. And so the fact of the matter, what's happening now is there's a prediction that not only electric cars are taking hold, but driverless electric cars are going to be the big thing. And so as that happens, less motor oil will be necessary, less motor oil will be used. That being said, there's kind of this isn't just a simple analysis. We're talking about countries like the United States, and we're talking about countries like the United Kingdom, for example, and cities, like big cities like New York or London. You're probably going to see a lot of driverless electric cars. But that being said, simultaneously, we have a rapid population growth in other countries like China, like India, like Africa. These countries, for example, may be still running on gasoline cars for quite some time, and I think there's kind of some give and take. There's going to be some automation, some battery cars, some driverless cars happening in certain places, but there's also going to be a huge demand for transit globally. And so I think basically what these reports are saying is this gasoline that's used in motor vehicles, 47% of gasoline is going to start declining. And again, the peak is going to be sometime in 2030. And so we have a demand side risk there, and we don't know how much the demand is going to shrink over time. And so I would feel a lot different about oil. I would have a bigger percentage of my portfolio in oil than I do now if it weren't for this single factor. There's actually a time when I wasn't really in oil, and this was not too long ago. I did go in actually a little more aggressively in 2015, and I did that because the pricing was just bargain basement prices. But before that, I was in oil, but I had a really low allocation, and I still have a relatively low allocation in terms of my overall portfolio. The reason for that, if I had to cite one thing from this entire list today, it's the demand side risk. I personally worry about that demand side risk. I don't think it will materialize that quickly, and I don't know how far the demand will fall, but I think it's certainly a risk. And so that would be one reason why I wouldn't potentially allocate more to oil at this point, other than reinvesting dividends, other than really taking advantage of buying opportunities if the price per barrel just plummeted again. But other than that demand side risk, it does concern me. Also, another thing I've learned over the years, there's a supply side risk. There's this new technology called fracking of oil. And basically what happens is oil and oil gases are trapped in shale rock well below the Earth's surface. So what happens is these companies drill these pipes miles down into the ground, and it's oftentimes called they do this horizontal fracking where it goes down and then it goes horizontally into the shale rock. And they basically take water, sand, and chemicals, and they pound it into the rock at very high frequencies. And it causes these oil and oil gases to seep through the earth, and it's captured. It's basically captured by the frackers. Basically, this is a new technology for extracting oil that was not available before. And the cost of extracting oil is a lot lower. And in fact, this is why the price of oil plummeted in 2015, because OPEC noticed that in North America there's a lot of this fracking happening, and a lot of these newer companies, they're using fracking technology to produce oil for cheap, and it's competing with them, and they don't like it. And so they flood the market with oil, intentionally drive down the price in hopes that they would drive these fracking companies out of business. Well, I don't know if it worked or not. It may have worked temporarily, but as of now, the price has recovered, and these guys are back in the game, and they're doing their fracking again. And so the challenge here is not only is demand potentially peaking in the decade starting 2030, but supply is growing. And supply is growing at these super majors, but supply is also growing because there's these new frackers out there, these startups, if you will, in the oil space. They're using these new technologies to extract oil, and they can do it at a very cost-effective price per barrel. And so there's a supply side risk as well. And that one doesn't keep me up as much as the demand side, because at the end of the day, I think supply will come and go, and no one wants the price of oil to be at $37, the frackers included. So I generally trust the industry to self-regulate itself and to self-regulate the supply, but the demand gets me a little more concerned that I just don't know what's going to happen with electric driverless cars. And so interesting stuff there, but these are the key risks in my opinion, and a reason again that I've got some good exposure to oil, but I'm not really into going too big at this point in terms of the long term. So what else have I learned over the years? I've learned that diversification is key. I have 37 stocks in the portfolio. I don't really want 3 of them to be oil companies, especially because oil is not core to my strategy. I want that exposure, but it's not core to my strategy. But certainly having 3 of them, that's kind of seems messy. It adds more complexity to my life, but I have to do it because what I've learned in the oil industry is oil spills and disasters and issues, they are horrible. No one wants them. They're awful, but unfortunately they happen. And so the fact of the matter is if one has all their eggs in one basket, one owns one oil company, and that is the oil company that totally messes up, they have a disaster, they have a spill, well, that stock is just going to plummet, and potentially they may have to cut the dividend. They're going to have to spend tons of money cleaning up the mess, fixing everything, and that can be disastrous for an investor. So what I've learned, if one does want to be in the oil industry, is it's going to be important to diversify. And I've done this by picking up 3 separate positions, because if I know one of them faces an issue, most likely at the same time the other 2 will not. And the fact of the matter is look through the history books. These types of issues can happen to anyone. They can happen to even some of the biggest names in the game. Way back in the day, ExxonMobil even is a company, has a world-class pedigree, has a great brand name. I don't own that one actually. And they had an oil spill way back in the day, and so it was a big one. It's called the Exxon Valdez oil spill. You could look that one up, but no one is immune to it. And I think these companies oftentimes these days hopefully are trying to do their best to avoid catastrophe. But the fact of the matter is history tells us this can happen even to the biggest and best names in the industry. So certainly I've learned, if one does want to be in this industry, it's probably prudent to diversify with a few names, and that's certainly what I've done with my 3. What else have I learned? Talked about this at length, so I don't want to spend too much time, but lesson number 11 is these just can't be core for me. Given all of this, there's certainly some good things, and the best thing is, honestly, if I have to pick 2 good things out of here, it's the diversification. I've got diversification into something that is not consumer non-cyclical, which is always good. And it's the yield. I've got phenomenal yield on cost. I've got an 8.12% yield on cost from the lot that I purchased in just late 2015. Doesn't get much better than that if one wants to drum up some really good current yield. That being said, this can never be core for me because of all of the risks that we've already discussed in today's video. So last but not least, lesson number 12. In the oil sector, I am not looking for capital appreciation. I will go into some examples in subsequent videos. Again, this is video 1 on my oil series for dividend growth investors, or dividend investors, income investors. And these are not the place I go looking for capital appreciation. And oftentimes, I've said in prior videos, I look at capital appreciation as a sign of a well-managed company. In this industry, that is not always the case. And having capital appreciation in the past, it isn't always the best indication of the future or which one is the best pick, which one is right for my portfolio. So it's very much an industry that goes counter to some of the philosophies that work in other industries. And so that's lesson 12. I'm going to throw in a bonus lesson, number 13, that I didn't even write here. Debt. We have discussed at length some of the risks. It's cyclical. I'll tell you another risk is the technologies are changing, and the technology to extract this oil from the ground, it is expensive, and it is quite an investment. I like to look at debt. I like to look and invest in oil companies that have manageable amounts of debt. The debt is not too high. The debt is manageable. So the last thing I need is a company with a big dividend, a ton of debt, and all of a sudden the price of oil plummets. What's going to happen? Not good things. And so from a dividend perspective, from a long-term perspective, I'm trying to buy companies that I can hold forever and will pay a stream of cash flow forever. I need companies that manage their debt well, and managing your debt is more important in this industry than most other industries out there. So that's bonus lesson number 13. So thanks for watching today. I am excited about the next few videos in this series, and I'd be curious out there. I know we have a thriving community here on PPC Ian of dividend investors, income investors. What do you guys think of the oil industry? Do you invest in the oil industry? Do you not invest in the oil industry? Is it core to your strategy? Is it ancillary to your strategy? I'd be really curious how it fits into your strategy now that you know in general how it fits into mine. And so if you have a comment, please include it below. And if you want to support this channel, you like this video, that you found that this video and my other videos are helpful, I want to encourage you to please give a thumbs up, to like the video, to subscribe, to comment. All of that, it means the world to me, and I read all of the comments. I do my best to respond to them all. Sometimes it may not be for a few days because there's so many these days, but I try to get to all of them. So thank you for the comments. Also, I want to thank everyone who asked me to produce this video, especially my good friend who just has been asking quite frequently, Ian, come on, it's time for your oil videos. So thank you for that. This is I finally got to it, so I'm excited about that. And before I leave today, full disclosure, there's one stock I discussed today that I own in my portfolio, and that is PepsiCo, ticker symbol PEP. I am long on that stock. I own that stock. Also, before I leave today, in terms of a disclaimer, I'm not a licensed investment advisor. Today's video is not investment advice. This video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please do consult a licensed financial advisor first. Thanks for hanging in there. I hope you enjoyed my top 13 insights that I've learned from investing in the oil industry over the years. And I'd be curious if you have any other insights as well. Share them below in the comments. Thank you so much, and I will see you in the next video.